Welcome to GRE. I'm your host, Keith Weinhold. Financially, you need to play a game worth winning. It's not being debt-free. Instead, I discuss how at each age, when you're 20, 30, 40, 50, and beyond, it's about being financially free. Then, in an era where mortgage rates are 7 to 8%, we go straight to the source in Florida on how to get 4.75% mortgage rates on new build property today on Get Rich Education.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Framingham, Massachusetts to Dillingham, Alaska, and across 188 nations worldwide. Yeah, you and I are back together here on episode 471 of Get Rich Education. I'm your host, Keith Weinhold. You've got to play a game worth winning with your personal finances. Most people play the wrong game their entire lives. Now, but you're already initiated on this. Debt-free just means that you don't owe anyone anything. Financially free means that you've got enough passive income that you can do what you want to do when you want to do it. So financial freedom, that's the flex. Now, when you're around age 20, you might be pretty new to full-time employment by 20. And you know what? It can actually feel kind of good when you're in your early 20s and you're being paid what feels like a respectable income for the first time in your life. Now, 10 years go by, and by the time that you're 30, I think that a lot of workaday job types, you might tell yourself, making money is all right at this point, but I don't really want to keep doing this for the rest of my productive life. Maybe around age 30, you pursue alternative avenues of more residual income, but some people, they just keep plowing ahead, hating big chunks of their life and devoting energy at a full-time job because somehow you feel like you have to. It feels normal because others around you are doing that. To other people, though it's a minority, these people are you, because instead, maybe around age 30, you tell yourself that you'd rather start building things that pay you to own them. The mindset supersedes the grind set. And by age 40, you are out. You're out of that soul-sucking job, and you're living the life that you've always dreamed of living already. And it sure could happen earlier than that. And by age 50, you're so glad that you chose the financially free track in life rather than the debt-free track. Back on the slow, scarce, debt-free track, the people that mistakenly think that debt-free is the game worth winning, they are still losing their zero-sum, non-replenishable resource of time in their 30s and 40s and 50s and 60s and 70s and beyond. And perhaps somewhere around 30, instead, abundantly minded, aware people like you develop your divergent, not running with the herd, financially free path. Instead, you believe that money is an abundant resource. It's sure easy to believe because you start having it all around you. You've built a financial windfall for yourself with simultaneous real estate cash flow, leverage, and arbitrage while you're young enough to enjoy it. And instead, the work at a soulless job type tries to get debt-free, tries to climb the corporate ladder, and believes that money is a scarce resource. And when you believe money is a scarce resource, that's why you think that you need to get debt-free. So those people defer their life and they get eaten up by inflation and zero passive cash flow. Now, that type of person by age 50, they are asking themselves where all of their time went. Where'd the time go? Well, it went to a job that you're not passionate about, and you can't change history. All those time chapters of your life are gone. There's no getting them back. And you begin to realize that the corporate ladder that you were climbing was leaning up against the wrong building for decades. So those are what the two paths look like of those in their productive working years. There's never enough debt-free world versus the money is abundant, financially free world. If you retire debt like paying off a mortgage early, all those dollars are gone when they could have been leveraging, say, 5 properties at once. Now, if you're late to realize this, like you didn't have the financially free epiphany by age 30 or whatever, it's not too late. You're going to remember that in recent months here, we had 2 GRE listeners come out of the show for 2 different episodes, Scott Saunders and then Sean Finnegan. Sean, you might remember that he was the inventor of a home gym system. He didn't hear this show and start until he was 52, and he's fairly quickly gotten to his first $2,000 of monthly passive cash flow. Financially free beats debt free, and financially free is the game worth winning. Retiring debt early means that your dollars cannot be employed in true wealth building activities. Now look, you might call me old-fashioned on this, but I like the integrity of doing what I say I'm going to do, following through, and following up. We check back at the end of the year here to see how GRE's housing price appreciation forecast from the previous year actually went. Back in January, we had the return of an agricultural real estate principal where the cash flows didn't hit what were targeted. So we had them back on the show and followed through and discuss why that happened. And now, you might remember that a few years ago here on the show, I introduced you to the novel concept of being the Debt Decamillionaire. Yes, that means that you've achieved $10 million in debt, which doesn't sound like an achievement to some people. That's the Debt Decamillionaire. I recommended this as a potentially desirable path for you, although many could deem it iconoclastic or even heretical. If the only thing that I knew about you is that, say you had $10 million in real estate debt, I would then know that the chances are good that you're a financial winner. Yep, it's actually unlikely that $10 million in debt would make you a loser. Not only would you have to be creditworthy to even get $10 million worth of debt, just think about if you would have tied up that much debt, say, 5 years ago. Well, now, how has it actually gone for the person with $10 million in income property debt over the past 5 years? Let's follow up on how that would look. We've had perhaps 25% cumulative inflation since then, with higher wages and prices and salaries and rents. So then your $10 million in debt is whittled down to just $7.5 million of inflation-adjusted debt. So inflation passively beat down your debt for you that way, plus your tenants would have paid it down to somewhere below $7 million. So now you would be $3 million wealthier just off the debt debasement alone. That's the debt side. And then meanwhile, over on the Debt Decamillionaire's asset side, your property value that you borrowed against might have gone from something like $12 million up to $18 million. And all this is happening while it created leverage, cash flow, and a tax benefit for you. And all right, say you only managed to tie up $1 million in investment property debt, not $10 million. Well, then just take 10% of all of those numbers and pat yourself on the back for being a debt millionaire. Maybe not a debt decamillionaire in that case. Instead, high inflation made the debt-free approach hurt, really sting over the last 5 years. The opportunity lost there. Debt-free is playing small ball. It's saying money is a scarce resource. And it even correlates more with people being addicted to a paycheck. I mean, there is a benefit to a paycheck, but is the trade-off worse? Paycheck dependence, that is like you being addicted to a time thief. That is, unless you get an unusually extraordinary amount of meaning from your work. And in that case, hey, that's great. Now, a high interest rate environment, that could narrow the gap between how much better financially free is than debt-free. But we're not in one of those. We're in a historically average interest rate environment. But in just a few minutes here, we'll bring in a prominent American home builder of build-to-rent homes that'll tell you how to still get mortgage rates as low as 4.75%. In fact, the time in the market cycle is really right for talking about this. You're going to remember that last month, housing intelligence analyst Rick Shargett and I discussed here why today's market is a good opportunity for residential real estate investors. It's a bad market for primary residence home buyers. It's a bad market for flippers. It's a bad market for real estate agents with their lower sales volume. And it's a decent market for many home builders. I am in Chicago today. Next week, I'll be in my home state, the Keystone State of Pennsylvania, where I'll sit down with Richard Vague, the Secretary of Banking and Securities for the great Commonwealth of Pennsylvania from 2020 to 2023, there in the state capital, Harrisburg. It is a cabinet-level agency. He was appointed to that position by Pennsylvania's governor, and he also sits on the Ivy League University of Pennsylvania Board of Trustees. And I'll be sure that he understands some core GRE principles here and get his opinion on those. That should be a really interesting episode next week. I don't know what kind of turn that's going to take. So to review what you've learned so far, I think you already know that financially free beats debt free. Rushing to be debt free, that exacts an opportunity cost on you. It postpones what you really want, financial freedom. And once you get financial freedom, if you desire to be debt-free after that, then, okay, great. Let's discuss how to get lower Florida insurance premiums, 4 3/4 mortgage rates, and a free year of property management. A lot of our listeners have acted on this, and I don't want you to miss out because I don't know how long all that can last. You are hearing two voices of GRE Marketplace, Chris and Jim, along with me today. We're talking about what's consistently one of the fastest growing markets in all of America, and recent years just seem to intensify the fact that people and tenants are moving here. Hey, fellas, welcome back onto the show.
Thanks for having us, Keith.
Thanks, Keith. Good to see you.
Now, you're a home builder, so that means you're largely building brand new construction build to rent homes. I think our audience knows what build to rent means. The investor buys the property, and then you can place a rental tenant in the property for that investor owner. You've been doing this since 2008, and you've helped so many of our listeners buy income properties, so thanks a lot there. As we're in this higher interest rate environment than we were a couple of years ago, you must likely pay higher interest rates yourselves as builders in order to finance your building versus what you did a couple years ago. So as builders, how do you navigate higher rates?
Really, the same way as everybody else, we're paying them. So we've definitely seen an increase in our overall rate. I mean, the biggest thing that you can do, or that we're doing anyway, to mitigate that is, building more with cash than debt to keep those interest costs down. Of course, that, has a reduction in our cash on cash return, but nonetheless, still a way to, from a total dollar standpoint, decrease that interest spend a little bit. But otherwise, we're affected by these higher rates just like everybody else is.
Now, you have long offered properties across the southeastern United States, predominantly across vast swaths of Florida, sometimes in Georgia, but more recently, you've really been focused on that geography in southwest Florida. Now, I think a lot of people tend to be more familiar with southeast Florida rather than southwest Florida. But southeast Florida, generally for the production of long-term cash flow and good returns, southeast Florida is generally something that we avoid because you have higher purchase prices and higher rents aren't that much higher. They don't keep up proportionally. So as you, the listener, build a map in your mind's eye, southeast Florida, generally that area that we avoid for investors, from north to south down the coast, it's West Palm Beach, Boca Raton, Fort Lauderdale, Hollywood, and Miami. Generally the areas that we avoid for long-term returns. And you're in southwest Florida, so we're talking about Charlotte County and Lee County. So can you speak to that and why you focus your building for investors in that area of southwest Florida?
You hit on some of the reasons in your intro there. The southwest market, we're still able to find attractive land prices. So we're still able to buy lots and land at reasonable prices compared to southeast Florida. The Miami area, if you can find land, it's absurdly priced. And southwest, we're seeing a good amount of inventory, of land inventory, that's priced right for us. We're also seeing that because of that proximity to Southeast Florida, it's not that far across the tip of the state there, we see a little bit higher rent rates as a result over in Southwest Florida than we do in some of our other markets. So for the amount of dollars we're paying for land, we're getting a little bit more rent per dollar of land cost than you would see, say, in Miami. For us as a home builder, that's very attractive. We're looking for ways that we can make yield for our clients because all we do is build to rent.
Well, no, another thing that's important to help make yield, those cash on cash returns, is insurance rates and taxes. I mean, where you just talked about, that Southeast area has the most expensive insurance and the most expensive property taxes. So Southwest Florida does bring that down a bit. And with the cheaper buy-in, we're able to get the fundamentals to work a lot better. And with that, coupled with the growth in Southwest Florida, has actually been the greatest in the state of Florida. Florida was the top growing state through the last few years, but Southwest was actually the fastest growing of all of Florida.
If you're buying a primary residence, hey, maybe you want proximity to Miami and all that excitement or whatever else there is. But when you're more numbers conscious as an out-of-area investor, you're really more concerned about things like lower property tax rates and lower insurance premiums in Southwest Florida. I want to ask you more about the insurance premium shortly, but any other reasons? And talk about some of those areas that you're specifically in that geography.
Yeah, we're in Port Charlotte, Punta Gorda, Inglewood, which are all in Charlotte County. And then in Lee County, we are in Cape Coral, Fort Myers, and Lehigh Acres. Those are the geographies that we're in Southwest Florida right now.
And where's the investor appetite? What product type are you building there?
Mostly we're building single-family homes and duplexes. We do have some larger product that's coming out probably in late 2024, some multiplexes, really primarily duplexes and single-family homes.
Now, some might think that a build-to-rent home builder like you, okay, you're building with an investor in mind, but I'm just going to guess that actually primarily you think about the tenant in mind. Where is the tenant demand going to be? And that's what product type I'll build and what area I'm going to build in. Because if you're serving tenants, ultimately that's going to trickle through and you're going to be serving investors because you're giving tenants what they want first.
Absolutely, yeah. And that's why, we're very detailed in the designs that we come up with for our build plans. So, we design the product that we're building based on what we see that appetite in the market. In that market, we have two single-family home types that have performed very well for us. One is a 3-bedroom, 2-bathroom single-family home, 1,357 square feet. And the other is a 4-bedroom, 2-bathroom, 1,617 square feet. These are smaller homes, so that we can keep the cost down so that we're maximizing the rent per square foot. As you see homes get larger and larger and larger, the rent doesn't keep up with the size of home as it gets over that 1,800 square feet.
Right.
So we've designed some very efficient product that, looks great, looks appealing to the tenants, has a great feel to it, but also we're able to keep the size down and keep costs down. And then for the tier of tenant that maybe isn't looking for a single family home and wants a little bit lower rent, and by the way, in Southwest Florida, a little bit lower rent is maybe $1,600 a month. That is what somebody can rent one of our 2-bedroom, 2-bathroom duplex units for. And those units are typically around 1,000 square feet, between 1,000 and 1,100 square feet. So again, we're getting that economy of scale in that we've got a duplex. So we're building a couple thousand square foot building, but we're leasing each side of it. So we're keeping the cost down for each individual tenant so that we're, again, maximizing the return. So the dollar per square foot of what we're building is attractive so that we can get our clients a great rental yield.
The cost of nearly everything has been up substantially in the past 3 years. So with those rent amounts, we're going to talk about where purchase prices are today, and we're going to dig in more at what's been a real sore spot for some people, hotly spiking insurance premiums. We'll get those numbers when we come back. I'm your host, Keith Weinhold. GRE listeners can't stop talking about their service from Ridge Lending Group and MLS 42056. They've provided our tribe with more loans than anyone. They're truly a top lender for beginners and veterans. It's where I go to get my own loans for single-family rental property up to 4 plexes So start your pre-qualification and you can chat with President Chaley Ridge personally. They'll even deliver your custom plan for growing your real estate portfolio. Start at ridgelendinggroup.com. I'll just tell you, for the most passive part of my real estate investing, personally, I put my own dollars with Freedom Family Investments because their funds pay me a stream of regular cash flow, and returns are better than a bank savings account, up to 12%. Their minimums are as low as $25K. You don't even need to be accredited for some of them. It's all backed by real estate, and I kind of love how the tax benefit of doing this can offset capital gains and your W-2 job's income. And they've always given me exactly their stated return, paid on time, so it's steady income, no surprises, while I'm sleeping or just doing the things I love. For a little insider tip, I've invested in their Power Fund. To get going on that, text family to 66866. Oh, and this isn't a solicitation. If you want to invest where I do, just go ahead and text family to 66866.
Hi, this is Rich Dad Advisor Garrett Sutton. You're listening to the always valuable Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education. We're talking with two voices of GRE Marketplace. You can learn more about them and their properties at gremarketplace.com/southeast. Yes, we're talking about Southwest Florida, so there are a few ordinal and cardinal directions flying around here, but because they're in the southeastern United States, that's a call to action that you can connect with if you want to learn more. Chris, why don't you tell us more about both the prices and the rents currently?
Take one of our duplex models in Southwest Florida. So this is a $474,000 duplex, and each side of that duplex is going to rent for approximately $1,600. I mean, we've seen some rent gains down there. So we've seen some rent in certain areas as high as $1,700 to $1,725 per unit. But just for a general statement, we're seeing more of an average around $1,600 per unit on those duplexes per side.
Amidst this awful affordability for a lot of America in a lot of places, and a homeownership rate that's currently at 66%, I'm potentially seeing that homeownership rate fall to 65 and even lower, which would create more renters and more rental demand and higher occupancy and higher rents. So just kind of speculating on what we could see the next few years. Do you think that that translates into Southwest Florida?
I think it absolutely does. I mean, I think Jim mentioned earlier, this is one of the fastest growing areas in the country. It's just hard to keep up with the amount of demand that there is, in that market. So that is going to happen over time. I think we're probably in a part of the market right now where you still have conservatism amongst both the tenants and owners of homes. So, we see a lot of people just anecdotally that are not moving out, and there's not been as much new home creation, new family creation. So, we've seen a lot of people sticking with their relatives for a little bit longer, or living at home for a little bit longer. You keep hearing about, when is the Fed going to push us into a recession? It may or may not ever come, but I think people are just now starting to get used to this new interest rate environment that we're in, and starting to realize, hey, I need to go live my life. With the sheer volume of people that are coming to Southwest Florida, and the fact that we're going to start seeing more of the people that are already there, creating more households, meaning more family units, we're going to start to see, absorption pick back up again. Now I say again, because absorption was out of control in 2021 and into 2022. And then as people started to get a little bit more concerned, we saw that slow down some. We do anticipate that is going to pick up pretty rapidly here, particularly as people start to have a little bit more positive consumer sentiment.
People that move to Florida crashing on lumpy sofas, that's the sort of thing that has a rather finite life expectancy. They want to get out and rent their own place. So that's on the renter, the tenant side. Here on the investor side, we're thinking about higher expenses when it comes to insurance premiums. Florida has had somewhat of a problem here, but I know with your product type, you have somewhat of a solution for that. So that's more of a regional thing. And then later, let's talk about the national thing, the higher mortgage rates and what you're doing there. So talk to us about the insurance premium environment in Florida.
Yeah, insurance is always an interesting thing, and it's become almost a buzz here in Florida. Oh, we heard about the Florida insurance. And when someone says to Chris or I, oh, I heard the insurance in Florida, property insurance is so expensive, I always follow up with the question on which property, because there is a big difference between a property built from 2004 or newer or older. And the reason why is after the giant hurricane here in 2004, they changed the standard of building that needed to be here, the certain height of land that you had to build on, the structural integrity, and it really worked. And we saw that through the last big hurricane here where, we had very little damage to hundreds of projects because we were built to these higher standards. And we were built instead of 2 feet above sea level, we were at 13 feet above sea level. And flooding's the main problem for hurricanes.
Right.
And hurricanes are what really cause the insurance analyzing departments to analyze the price of your insurance. And so you want to work with an insurance company that really analyzes and knows Florida. And if Chris and I have learned anything, Keith, it's you got to shopping around. And that's our job for all the clients that we work with. We do our best to find people that Chris and I have personally used for our own portfolios and for so many others. They're not financially affiliated with our company, but they do a great job. So we have a great insurance story for you. Last week, Dr. Investor of ours that's bought several in Southwest Florida reached out to us and said, guys, I just got my new insurance premiums. They used to be $1,616 a year. I just got a new quote for $4,600 a year. Whoa. And our first question to him was, who is your insurance provider?
Yeah,
well,
that's 3X.
Yeah, right. Well, he's a great client of ours, has bought several properties, but somehow without us knowing, about 2 years ago, he had decided to switch insurance to a national insurance group that didn't specialize in Florida. Someone had told him to do it. He did it. Well, we said to him, hey, why don't you before you have a real meltdown of this new cost, 3 times the amount, let's get you a quote from our preferred insurance person. Well, sure enough, our preferred insurance person had a quote back within about 3 hours, and it went from $1,600 to $1,200. So
no, this technically it went from 1,600 to 46 to 1,200.
Before, yeah, good correction. Well, and that's the important thing where, we always joke, and that's part of this business where it's whether it's materials or the lots we're purchasing themselves or our subcontractors, our job for our whole venture is to shop around, and that includes insurance. And that was such a good reminder of why we're always trying to stay on top of that. So not only is it what type of property, and any way you look at it, new construction gets a break on their insurance rates because they're less risky. The way that they're placed, the way that they're built. The insurance companies analyze that, they give you a better deal. And then if you go, one company could tell you a very high price like we just saw, or you can work with a preferred person that we refer to. You don't have to, but we've seen great results. They give great coverage. And wow, yeah, I mean, we're talking almost 4 times less than some of the other quotes that were out there. So we see that the insurance is a very manageable problem, Keith, especially when you're staying with new construction, and especially when you're always trying to keep up and have great relationships with insurance companies that will get it done for the right price.
All right, so 2004 is that dividing line where construction that takes place that year and later is subject to substantially lower insurance premiums than earlier builds, which would make sense because I'm an income property investor that has single-family homes, and I have 1970s built single-family homes, and they have seen 2.5x hikes in about a 3-year period. And then on the new build side, I don't see anything like that. And in fact, the fellas here, the 2 voices of GRE Marketplace, they might have an insurance recommendation for me to talk about here after the show. They are motivated and incentivized to make sure your numbers work. If you were buying a primary residence 3 years later, I don't know that your agent is that motivated to come back and try to help you with your insurance because you aren't as numbers centric as you are here as an investor. So those are insurance premiums that you're really helping keep in check because you deal with newer build properties. And then the other expense that spiked for so many recently that really puts downward pressure on investors' numbers are, of course, those spiking mortgage rates. Can you tell us about that?
That's another thing that's been a big thing on the forefront. What has slowed down real estate in a lot of areas is not The demand is there because the supply is low, but the interest rates have started to affect the affordability or the cash flow for people. So to Chris's credit, he said, what can we do to control the interest rates better? And this is something that I thought was completely out of our realm. Now, doing certain mortgages for myself, I had paid some discount points to buy down my rate, but I didn't think I could do it to the level that's possible that what's called a builder forward commitment will allow you to do. So what we've started to do is to pre-buy money, Keith. It's basically what we're doing. We are pre-buying packages of mortgages, and we're paying a very pretty penny to be able to pay it down. But as you know, a lot of our clients will come to us from you and say, hey, I just got quoted from a mortgage broker in California for 7.25%. And we say, well, right now our rate is 4.75. And they say, you're lying or you're crazy. I said, we're definitely not lying. We are a little crazy because we're paying very good for this mortgage money. Well, what the banks will allow us to do, especially since we're in a position now with a healthy balance sheet and the ability for the banks to allow us to do this, we can pre-buy mortgages for your clients, get them locked in on a 30-year AM, 10-year fixed at 4.75. And when you're able to do that, you're locking people in 2.5 points below what the normal interest rate out there is. And you know what that does, Keith. That brings us back. So many people said, gosh, I wish I had locked a rate before June of 2022, right? We all wish that. Right. So Keith, we don't have a DeLorean like Back to the Future, but we've done our best to get you back to that rate. We're paying those points up front, and they're able to enjoy that to get the investment out on the right place. So the real way that we've been able to solve this problem the best that we can is to buy our own mortgages and then offer them to our clients at this lower rate.
Buying it down to 4.75% for that investor. Does that investor need to come up with more upfront so they're not the ones participating then in paying down any sort of discount points?
It really depends on their individual credit. There could be something that they would have to pay. I mean, we've seen some of our clients having to pay, somewhere between 1.5 and 2 points, depending on their credit score. If they've got super good credit, they may not have to pay anything at all. When we buy the rate down, we buy the rate based on essentially a pro forma of the borrowers that are going to use it. That last little bit of buy down could, in fact, cost the investor something, or it could cost them nothing. So it really just depends on them individually. We have a couple other programs as well that are very attractive. We have one that's a 30-year fixed all the way through, and we're seeing a lot of times that only gets the rate to 5.5 as opposed to the 4.75, but still a very good rate. And we're seeing that most people, if they've got over a 700 credit score, are not having to pay any points for the 5.5.
That's 5.5, Keith, where if that's with them paying no points. Now, if people say, hey, I'd like to buy it down a little more, we're going to pay a big chunk to get you to 5.5, but they could pay another 1 or 2 points and possibly get down to as low as 4.9. So again, you're getting into the
30-year.
That's 30-year fixed. We're really trying to control the interest market the best we can. And we found people are saying, how are you still doing the volume? Well, we're solving the financing issue.
That is hugely helpful. Okay, so to review, commonly they are getting a 4.75% interest rate, 10 years fixed on a 30-year amortization. That is super attractive, solving the pain point for a lot of people. And that's one reason I wanted to have you guys on, to hear this straight from the horse's mouth, because I've been talking about it, the 4.75% rate buy down in a really attractive market for new build property in today's environment, which is almost incomprehensible to some people. So that's great. You're really helping solve the investor pain point, which makes sense because you're building homes. You're in business to keep turning homes over. So yeah, I really think that's going to help an awful lot of people. We'll just wind it down and wrap it up. Are there any last things that we should know about income property in Southwest Florida?
2 other things I know that we've powwowed with you on the last several months, Keith, was we wanted to solve the financing issue, which I think we're doing the best we can on that. We wanted to solve the build time. So when people are looking for a new construction, they might think, oh, I have to wait a year or longer. Right now, you can close on a new construction property since we're on a continual build cycle. You can close on one of our new construction properties in less than 60 days. So that's a very quick close time for you if you're looking to move your money. So that means if you want to go 1031, you have the ability to 1031 into a new construction property.
Great.
And to help again with that initial cash flow, along with the better financing options we're offering, we are on a lot of our programs offering at least 1 year of free property management. So when you get that 1 year of free property management, we found that goes right to the bottom line. right there that's going to help up your cash on cash returns to get the investment off on the right foot.
You solve for the management and the insurance and the mortgage rate. That's fantastic.
Yeah, we're working hard down here, Keith.
Well, if you want to learn more about it and get started, you can do that at GRE Marketplace. That's directly at gremarketplace.com/southeast, where you can get started and get under contract for new build income property in a very investor advantage place that still has high net in-migration. Over there on that page at gremarketplace.com/southeast, there's a 1-minute video where you'll tour the inside of their properties and see the great durable finishes that they put into their properties. You also see a 7-minute video where we interview their property manager. You can hold it in their management portfolio for the production of long-term, relatively passive cash flow. Fellas, you're really solving a lot of problems for investors. You have such foresight, so we really appreciate your expertise and taking such good care of our listeners.
Well, thanks for having us.
Pleasure.
Keith. We really appreciate you.
Usually, you see fewer investors that want to exchange their properties in a higher interest rate environment because you're trading in a lower rate property for a higher rate property. But here, 1031s, those exchanges, they look more attractive because we have bent that back with rates down to 4.75% and lower insurance premiums on post-2004 built Florida property, plus 1 year of free property management. So many of you have been acting here on this either by yourself through GRE Marketplace or working through one of our free investment coaches. So if it can help you, don't miss out. This won't last forever. You can get started at gremarketplace.com/southeast. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.